Did I? Yes. All right. Yeah. So Sharavana Prabhu sir is ACMA, FCA, LLB, and he actually started his journey from Sri Sitaram Vidyalaya Matriculation Higher Secondary School in Chennai, where he is consistent topper from the school days. He cleared his graduation in commerce, and there he secured silver medalist in Vivekananda College, Chennai. He is a qualified cost accountant and associate member of Cost Accountants of India. In ICAA, he has secured All India 7th rank. Kudos to you, sir. And he is author in the various journals. He is a fellow member of ICAI, and he's been in practice more than 10 years in the field of taxation. He also completed his LLB degree in the first class. He's been authoring on various topics and speaking on various forums, especially to NASIN, Direct Access Regional Institution, CNDG, ICA Forum, ICAA Forum, and various other colleges also. He is very energetic and does all engaging lectures and very applauded by many in his sessions. He is also part of editorial board where books are being published, and more than 400 plus technical programs is addressed. He also appeared in TV programs in the interviews on GST and finance related topics. With this brief introduction, I request Sharavana Prabhu sir to discuss on cross-border transactions and case studies on this. Over to you, sir.
Thank you. Again, I think I should keep my introduction a little bit even more brief. Anyway, so thanks. Nice hearing from.
Sir, your voice is little low.
Is it no?
Konjam break out.
Okay. Is it better now, Venuji? Is it audible? Or I'll just remove the headphones.
Maybe if you can remove the headphones, that would be better, I feel.
Okay. So
let's see.
Questions are how to just be a little close to the speaker. Okay, I'll remove the headphones. One second. I think I'm not able to hear you, but I hope you are able to hear me.
Yeah, now this is better. I think without headphones is better now.
Better. Okay. So
yeah.
So again, thanks a lot, Venuji, for the introduction, and I think thanks to Arup, Venu, and part of the entire management team. They've been consistently putting up these sessions, and I think which most of us look forward to also as part of our Saturday routine. Learning, even after so many years of practice, you get a lot of learnings from these sessions. So I think really hats off to them. And thanks for inviting me to share my whatever little knowledge and experience I have with this particular August forum. Now, when I once again a small cross check before we go on to the session. Now I think my voice is all clear to you. Face, then not that much important. So I think voice is clear.
Voice is clear.
Now it is better.
Now it's better. So I think the headphones I took it off. It's better. Fine. So again, I addressed, I think many, as Venuji was saying, I mean, like thousands of people at the same gathering, but I never had this sort of an anxiety or a sort of an apprehension or sort of this one more in those sessions than as compared to addressing you all today. So even though we have a very handful of people, I mean, like this gathering, I really value it that much. And I think of only one adage. If I can just take 2 minutes of time to just share a small adage. So what is that? Quality over quantity. So I think that is the one, what is that? Emotion I can, or one saying which I can say, which really defines this particular gathering. So I'll just share a small story from the Mahabharata, not a long 2 minutes, more than if you can indulge me. So wherein all of us know that the Kurukshetra war was happening. So and at that time, both the Kauravas as well as the Pandavas, represented by Arjuna and Duryodhan, they were trying to canvas more strength for their army. So, and during this particular episode, they all knew that they had to come to the Lord Krishna to again, he will be the deciding point of this war. So both of them came, and he had two things to offer, Lord Krishna. So he had to, one thing he could offer was himself. Second, he could offer his innumerable, vast, and undefeated army. So, and as we all know, to put the long story short, Duryodhana chose the Narayani Sena, which is the huge army, whereas Arjuna chose the Lord himself. So, and we all know what happened. So the quality mattered more than quantity. And I think whichever side Lord Krishna was there, I think they came out on top at the end. So therefore, this particular forum, it's like more of quality as compared to the quantity. And I will also use this same motto for my session today, quality over quantity. So we are not going to go into like so many cases, probably even a handful of cases. Probably these cases I'm sharing are cases which I have been part of personally, and which I've, I mean, been fortunate enough to represent or to have a look at over whatever little years of experience I have. So again, so we'll do quality over quantity. I have a lot of cases to discuss today, but even if we discuss, let's say 3 or 4, I'll be very happy. And each of those cases, I think we'll have a very interactive discussion. We'll go deep into a particular case and we'll try to see all the what is that arguments which are which can go back and forth. So I think with all your permission, I will adopt this approach of quality over quantity. So can we go on? Yeah, great. Now the first case which I want to again, I've been fortunate enough to be part of, which I want to put you all. I'll take you through vividly through the facts. So as I said, we'll go deep, even 2 or 3 cases, I don't mind. We'll go very deep into it, and we'll see the facts in detail, and we'll see all the arguments that are possible, and we'll take it in that spirit, if it is okay with all of you. Now, the first case here is that of the intermediary. Now, today, the topic given to me, just to recollect, is cross-border transactions, GST controversies, and beyond. So, what I've done is whatever cases I've been fortunate enough to be part of, I've narrowed it down to cross-border transactions. Point number 1. So whatever cross-border transactions are there, that is the first filter I've adopted. The second filter which I'm adopting is, I'm not going to go into the quantity. As I said, the bread and butter of the issues, all of us, I think, are this quality forum, need not go into all those bread and butter issues with regard to exports, so on and so forth. What I've taken is really niche issues, really something where makes us think and made me think also. So that's sort of a qualitative cases I've taken, and I've really filtered it down to somewhere around some 7 or 8 cases, at least 3 or 4 we'll try to discuss it today. So cross-border transactions. So as probably all of us are aware, one of the important areas in cross-border transaction and where a lot of controversy is coming is with respect to intermediary. Now, intermediaries, I need not sell this importance of this particular concept. Why? As you all know, this is one of the concept where there are so many circulars which have been issued. I could hardly find any other area where so many circulars are issued on a single category of service. So, in fact, in this year, probably every couple of months, we are seeing circulars coming on this intermediary concept. So let's go into the facts of this particular case. Now, this is a case where, as it is given in this one, I will take you through the diagram, where there are certain suppliers in India, let's say A. There are certain buying agents, let's say B, and they're also in India. And there are certain end customers who are engaging these buying agents. So let's call them as C, they are outside India. So A and B are in India. Now, what is typical, how this transaction works? I'll take you step by step or detailed into this particular proceedings, which I was fortunate enough to be part of. This was the crux of the transaction. C engaged B. The end customers, let's say in US, UK, Singapore, somewhere, you can imagine, they engaged B buying agents in India. What did they want to buy? You can imagine some sort of a item. Let's say, let's take something like a, what is that, household materials, right? Household furniture related items. So you can think of a store like I wouldn't say Decathlon. Decathlon is more of a sports oriented store, but something like that you can think of Walmart or something where it's a themed store focusing on a specific set of items like a Home Depot or something like that. Now, These people who are located in US, UK, and Singapore, they want to source products, and they want to source products more so. They wanted to come to India. Obviously, low cost advantage. Not only that, quality is also there. They wanted to do that particular sourcing from India. And therefore, these agents are also called as sourcing agents, as many of you may be aware. So buying agents or sourcing agents, they prospected a few people. Now, what these buying agents did, the facts of the case were like this. Now, first, I'll take you through a basic thing, then we'll go on to advanced discussions. The fact of the matter was, these sourcing agents, they did two activities. One, you can imagine, see, these companies are some companies who are trying to get into a new product line. You can imagine like that. Therefore, first they wanted a market research or a market study, right? I want to buy, let's say, some 20, 25 SKUs. They call it as SKUs or product lines. They want to get into 25 product lines, which they want to sell. They want to buy that from India. Okay, 25 products line. You tell me, sourcing agent B, which of these product lines I can get from which of the places in India meeting my criteria. They'll lay down some 10 criteria, quality criteria, quantity criteria, so many criteria will be laid down. So these are my criteria. So fitting my criteria, you please go ahead and source in India or try to do a study in India and try to find out where I can get this particular products and who will be the vendors, so on and so forth. So these market research will be done, point number one. As part of this market research, what will happen? These people, sourcing agents B in this case, will go all over India, scout for the various products in various geographies, let's say Gujarat, Madhya Pradesh, Chennai, Bangalore, so on and so forth, Kolkata, everywhere you can imagine. So they'll go and source the products and they will say, okay, in Gujarat, there are some 5 vendors who can do this particular level of inventory and they can do this particular quality, so on and so forth. 10 vendors in Kolkata, some, let's say 3 or 4 vendors in Bangalore, so on and so forth. So they will give all these study. So these many vendors are there. And this is the price point at which they can sell. They can sell it for this XYZ price point. So price points for various products. So they'll do the study, as you can imagine. Once they do the study, they will give sort of a report. They will not identify the exact vendors. Please be very careful about this, the facts of the case. They will not identify the vendors. They'll just do a study and give please note, whatever cases I'm taking you through, the facts that you understand are very, very important. So therefore, they won't identify in this report who are the actual vendors. They'll say Gujarat 5 vendors, Kolkata 10 vendors, so on and so forth. They'll just tell the number of vendors, price point, sort of a ambiguous but little bit more specific also report will be given. So a report will be given, market survey, market research, a report will be given. This is point number one. For this report, they will typically charge some amount of consideration. Let's say it is a fixed consideration. Let's say some $30,000 are being charged. $30,000 are being charged as part of the contract, part number one of the contract. Now, the foreign buyer, end customer, will evaluate this particular prospect or whatever study they have given. They'll evaluate this. They'll say, okay, I am more okay with Kolkata. So you go to the Kolkata vendors and from this area, you source me this product and you go and further identify the vendors itself. So the second part of it is the actual sourcing. So they'll identify the vendors. They'll say, okay, Kolkata, you told me 10 vendors. Now you give them the list of the vendors. And okay, now I'll finalize the vendors also out of 10. I will shortlist some 5 or 6. And finally, you will get quotations. Finally, you'll select 1 or 2 or 3, and you will give them the order. Then once the persons are being selected, the products are being selected, the sourcing agents will also actually ensure that the order is fulfilled. What is order fulfillment? Whatever timelines they are met, the shipping, logistics, everything is happening properly. End customer is receiving it, so on and so forth. The entire order fulfillment, including probably customs, will also be part of it. In many cases, they'll either outsource it or do it themselves. So therefore, the order fulfillment will also be part of this. For the sourcing activity, they will give a percentage basis of the commission. So they will say, whatever in this quarter or in this month, you have done the order value, you have sourced the component for me, I'll give you 2% of the consideration, 2% of the order value as the consideration. So these are the facts of the case. Pardon me, I've taken a bit lengthier, but now I think now the base is set. Now we can have some qualitative discussions. Now I'll start with the basics. I don't think I need to ask questions for this. I'll ask you questions as far as the advanced topics are concerned, but let's start with the basics. And any counter views are there? please feel free to interact. Am I audible to all of you? I mean, yeah, I hear pin drop silence. So are the facts clear to everyone here?
Yes.
Yeah. Okay. So please stop me wherever you feel that I am not audible or I'm going too fast or something. Please let me know.
Sure.
So therefore, in this facts of the case, the basic things I'll get it out of the way. In this qualitative forum, I don't think I need to ask this as a question. I hope that all of you are, first of all, recognizing the fact that in this contract, there are multiple supplies. There are bundle supplies, right? So, and point number one, I think most of us are in agreement that this will not be whether there's a composite supply or a mixed supply or something else. That's what we'll have to evaluate now, correct? Why? Because we'll have to see.
Sorry to interrupt. For the activity 1 and activity 2, consideration is the same?
Here I've identified it, Benuji. So first activity, a separate consideration is being identified for activity number
and
1.
Second activity, separate consideration, which is percentage of
percentage basis. Yes.
Yeah.
First one is on a fixed fee basis.
Yeah.
Second one is on a percentage basis.
Correct.
Right. So having seen this, I think all of us probably are in agreement, or any counter views are there, I'll welcome it, that these probably may not amount to. Now the question comes, as you can imagine, whether this will be zero rated and what, if at all, part of it will be zero rated and which are entitled to refund benefits. All these are the next questions. I hope you have caught on to all those things. Now the first question is whether this is a composite supply. In my probably opinion, this may not be, because again, we have two supplies which are, in my view, predominant or equally predominant. Therefore, there's no one principle or predominant. Again, counter views are welcome. This is just a discussion forum. I'm just putting my views here. So therefore, predominant supply, probably both of them are equally predominant. Therefore, this may not tantamount to a composite supply. I am giving my views. Probably second one, whether it's a mixed supply. That's the next question. Probably it may not be a mixed supply also, because there are two separate considerations being identified, as Venuji was also rightly asking. So therefore, there's no single price. Therefore, this may not amount to a tantamount to a mixed supply also. The CGST Act, so on and so forth. Therefore, now comes the question, if it is neither a composite nor a mixed supply, then how we'll have to take it forward? I think probably we can all agree that this may tantamount to an independent supply by themselves. So each of them have to be treated on its own footing, and both of them will be independent supplies by themselves. Now, do you all agree on this, or any counter views are there? Now let me take some views probably. Do you all agree that it is an independent supply, or it may be a composite or a mixed supply?
Sorry, can you please repeat your question?
Yeah, the question is, there are two parts to the contract, two separate activities being done. Let me summarize. One is a market research sort of an activity, for which a report will be given, a sort of an ambiguous but little specific report also will be given, market survey, market research, for which a fixed fee consideration of $30,000 or something you can imagine, a fixed fee is being agreed for a study. Once the company decides, okay, let me do this product, it's viable for me, because they have to evaluate their cost also. So once they evaluate that, okay, this product is viable for me, they'll go to the next step. This next step is not automatic, please understand. Once they take the report, do the study, and they are okay with this. Okay, now I can sell it for, let's say I'm getting it for $15. I can sell it for $50. So therefore it's viable for me. They'll do that viability study. And once they're okay with the product, they will go to the next activity. They'll give the next activity to our B in India, which is sourcing activity. They'll say, actually, you go and source it from this location, this much of value you source it. And for the sourcing activity, depending on the volume processed, value process, they'll give a commission, if I can say so. It will be like 2%, 1 to 3%, typically it will be there. This is how typically the sourcing transaction happens. There are some variations, but in a full sourcing transaction, this is the end-to-end. Now, having seen these two legs of the transaction, same contract with the same supplier in India, the same sourcing agent, he is giving both these to be in India. Both are part of the same contract and both are given to the same person. C is giving it to B in India. So having understood these facts, now my question, again, I'll repeat it for all your consideration. is whether these two supplies done by B to C, will they be composite supply point number 1 or mixed supply point number 2, or no, 3 they are independent supplies by themselves?
In my view, these are independent supplies because the consideration is separate, the deliverables are separate, and performance of one activity is not dependent on the other activity. So the first supply, that is market research, if the viability studies go positive, then only they will go to step 2. So there is
Correct.
possibility that the C may not find this viable and they may never ask for step 2.
Absolutely.
And they may just end up paying USD 30,000 in our example.
Absolutely.
So to my mind, and these are not composite or mixed. They are two independent supplies, rather two independent contracts forming part of one document.
Perfect, Amitji, perfect. Now, Amitji, therefore, do you agree that the first part of the contract, which is the market research, will be 0 rated, assuming all the other conditions in section 2, subsection 6 of the IGST are satisfied? Do you agree that they'll be 0 rated? And second part of it may not be 0 rated because it comes under intermediary.
Right. The first part will be in the nature of market research and not intermediary. There's no facilitation of supply of goods or service. It is advisory kind of a service. And therefore, this will tantamount to export of service. And the second leg, to my mind, fits into the definition of the term intermediary because the actual supply of goods is being overseen. Even the consideration is linked to the amount of supply. It is percentage based. So in one of the service tax education guide, one of the points that clarified, if the consideration is commission based, while it may not be the sole determining factor,
Correct.
but still the fact that it is commission based, that also gives us the conclusion that this is intermediary and hence liable to tax in India.
Perfect, perfect. So I think you have put it perfectly.
Yeah,
So
one
therefore,
more point is,
in my view,
Sharvana,
I
one
just
more
want
point. Sharvana, one more point we can add here is,
Yeah.
there is a principal to principal relationship between the supplier and the end customer, whereas the contract between supplier and buying agent is not principal to principal. So that way can we bifurcate that both are the distinct supplies between this supplier of India and end customer and buying agent and supplier. So that
Perfect.
also based on that also one can be a distinct factor between these two.
Absolutely.
Yeah.
So if you look at section 2, subsection 13 IGST of the definition of intermediary, yes, that is a good way of analyzing also. Perfect.
Yeah.
So I think all of us are to some extent are in agreement that these two supplies, even though done by the same B to C, and even though part of the same contract, two separate supplies are there. So they can be independent and one of them can be 0 rated, whereas the other need not be 0 rated. I think all of us are in agreement of this.
I beg to differ here. I consider it as a composite supply. The reason being, there are two steps. Yeah, it's a single contract. The consideration can be bifurcated. Absolutely no problem. But first is the feasibility study, which is contingent upon the second part, second leg of the transaction is contingent upon the first transaction. Unless and until you do the market study and you filter it out, and then only you get the customers. So both are related. If that being the case, if without the first step, second can't even exist. So how do we say that these two are two independent supply is my view.
So which is the predominant supply, therefore, principal supply?
Predominant supply is only the, filtering it out and giving the effective customers, like, vendors. The list of customers. What the second leg of the transaction is only intermediary.
So fine. So in that case, the entire contract per se now becomes non-zero rated, or it becomes a normal.
Yeah, that's my view.
So in fact, that was my second part of the case where I wanted to take this view and just change the facts a little bit, because that is where the really interesting discussion comes. But thank you for pointing it out at this thing itself, this stage itself. Any other views?
Shravanji, I was also coming to that point that if we cannot segregate these two and there's a combined contract for both the things, because somewhere down the line, the distinction which is being made can also be made artificially also, just to segregate it for an export of service and an intermediary. So if there are two, department will always view as a single contract involving two suppliers, wherein the principal supplier is the intermediary supplier. So there,
Thank you.
drafting has to be very precise in this case.
Oh,
that
perfect.
second depend upon the first.
All right.
I
So
think
Arti, again, just a small counter view. Thank you for this one. So I think Amit also pointed this out. I think this is something that we need to probably consider. There could be some products where the first activity alone could happen. Again, this is also to Sujata ji. There could imagine the C outside India will want to go into like 25, 30 products they want to source from India. They will do a study. So out of which once B gives the report for all the 25 products, he will not identify the vendors at this stage. He'll just give a report that this area, this many people will be there. So once he gives a report, probably that particular company C may not even want to go into sourcing with respect to even one product. So in which case the entire this is like too much costly. So therefore, I may not even go into the second aspect of at all, where in such a case, the first aspect, that is the market research, that consideration will be independently payable. So in that case, will it still qualify as an intermediary, or will still intermediary be a predominant supply? Because there's no intermediary supply happening at all in this case. Am I audible? So I think Amit ji also pointed this out. So what if the second leg does not happen at all? Will it still be a, what is it? So in that case, there's no bundle supply at all. And just because the second leg is happening, do we need to say that it entirely becomes an intermediary supply? We are able to recognize that the first part of the activity, it is happening separately. The second part of the activity is sourcing or order fulfillment, we call it. That is also happening separately. This is very tangible when the second part does not happen at all. We are able to recognize the first one itself as a separate supply.
And I have seen few of the agreements where there is a very clear scope of services of that agent, and as well as in case if it is successful, then the second leg of transaction will take place. So this kind of contract is giving a bifurcation of the supplies between the supplier and agent and with the customer. So I think that can take it up, as Arpit was saying, that contracts will decide. So I think that should be the base for deciding now that it is an independent supply. Yeah.
Perfect. So contract structuring has a lot of role to play in this. So I think that's why it took a lot of pain to tell the entire facts of the case. So here the contract is there between the same party only. So the first part of it is clearly defined, and the consideration is also yes.
And I think one more point to be considered is, say tomorrow when everything is going good, it is fine. But say tomorrow B and C get into some legal dispute, and C says that you didn't deliver the second leg properly, so I am not liable to pay you anything, even that $30,000. So in that case, can I say that $30,000 worth report was delivered successfully, and that much it has to be paid, whether or not I have not delivered you the second leg? So if that is clearly coming out from the contract, then also we can conclude that these are two independent supplies and are not interlinked or interdependent, and hence composite or mixed supply.
Yes. So I think Amiji has put it very elegantly. I think what he has told is what I meant to convey as well. So in which case, both the parts of the that is both the deliverables are identified separately, both the whatever milestones or whatever are identified separately, and the consideration for both of these things are also identified separately. So this is what I tried to convey. So probably anyway, so the idea is that yes, so this is what I wanted to point out, that in such cases, whether it's a composite supply or a mixed supply, or whether it is an independent supply by themselves. So if we are for the sake of it, again, it's not, all these are open questions. That's why we are discussing this today. Probably all the next two cases also will have so many open questions, and these are all very factual, specific cases also, which will have a larger learning. So assuming for a second that we are able to agree definitely yes, I welcome the other views. I'm just saying, assuming for a second that we are agreeing that there's an independent supply. Both of these are independent supply. Then my question to you, next question to all of you is it okay that in a single contract between two same parties are there, B and C, same parties are there, would a part of the contract be zero rated and the other part not be zero rated? Is that possible or is that okay? Assuming for a second that these two are independent supplies. Two parties are there, same contract, but two separate parts of the contract. One can it be treated as zero rated, other can it be treated as non-zero rated? That's my next question to you.
Sarvana, is your contract is a fixed commission plus variable commission, right? Or is
Fixed,
it only
yeah.
a variable commission? Because
Yeah,
if
so
it
as
is
I
a
was
variable
saying,
commission, then it will, yeah.
yeah, please go ahead.
Yeah, if it is a variable commission, then it is related with that transaction. If it is a fixed commission as well as variable commission, then we can say that it are two
Yeah.
different supplies. So that is
Yes.
one aspect which can be.
Perfect, perfect. So anyway, I think all of you have gone to the next part of the same case study. So here, yes, the two separate deliverables are there. And first one is a fixed fee, like $30,000 of fixed fee is being agreed. Whereas second part of it is commission based. So these are the facts of this case. So probably yes, two separate considerations being identified. So in which case, I think all of us probably for the time being can agree that a single contract between same parties having two separate parts of it can be treated as independent supply and one can be zero rated, other cannot be zero rated. Is that okay?
I think yes, because say similarly placed supply of goods transaction where a PO is given for say 10 items, one of them is exempt, another is 5%, some is 12, some is 18. So each item will be charged according to its own taxability because there are two different supplies. So it doesn't mean that entire PO will be exempt or entire PO will be at 18%. Same ways, here there are two items in one document and each has its own independent taxability and has to be analyzed accordingly. So one can be taxable and one can be zero rated.
Great.
And what's more, there is no cross-fall breach clause between the two. That
All
payment is dependent on second.
All right, perfect. So therefore, yeah, so these are certain questions that are arising out of this contract structuring. So thank you for all your answers. And probably now I'll just change the facts a little bit. I think Annapurnaji and Sudha, they also pointed out to this. Now let's take the same scenario. Now this is where, in fact, what I asked now is like a very basic case study which I wanted to give. Now let me change the facts a little bit. These are the actual facts of the case, right? Now let me just tweak the facts a little bit. As I think Annapurnaji was pointing out and Sudha also, that now let's take the contract and modify it a little bit. Now the real question starts. Let's assume, again, I'm drawing on the screen that there are two activities being done, very similar. But just like what we do as professionals, actually, not we shouldn't do probably, but probably certain people do a success fee model, correct? So therefore, let's assume a case where both same contract, same parties, two separate parts of the contract are there. One is market research. Second is the actual sourcing or order fulfillment. Now, let's assume a case where the contract is structured in such a manner that there is no fixed fee involved separately for the, there's no fixed fee involved. A market research will be done, study will be given, sort of an ambiguous but specific at the same time, a study will be given. The vendor will evaluate, okay, what products should I source first of all from India? What products should I source, from which geography I want to source? All these he will do a viability study, come back to me. And once he gives me the order, okay, you procure like let's say $10 lakh or $1 million you procure, he gives the order. Once the order is fulfilled, then finally a success fee is agreed. Let's say now in this case, now in the changed facts of the case, the success will be a little higher. Probably it will be 5%, and there will be no fixed fee. Now, having seen these facts of the case, that there are still two deliverables in the same contract, but now the entire thing is based on a success fee model, where the entire order is being fulfilled. After fulfillment only, a higher success fee is being, or a higher commission or whatever remuneration you want to call it, is being levied or being charged. So if the facts change now like this, in these revised facts of the case, what do you feel will be the answer? Is my question clear? So very same contract, no change at all. The only or two changes are, one, now it is becoming a success fee model. Therefore, second change is the success fee is also higher. So in these revised facts of the case, what do you feel is the answer?
So now the payment is ultimately dependent upon the customer being selected. So
Absolutely.
market research amount of fees is also dependent on the second part. So somewhere
Absolutely.
down the line, now there's a cross-fall breach clause that once the second part is achieved, then the first part would be resulting into the fees being received. So now the question comes, which is the primary service in this case?
Correct.
In my opinion, the primary service is selection of the customer, because if the customer would not be selected, the first part would not be resulting or fructifying into the fees part. So in my opinion, then it becomes a intermediary service.
Intermediate service based on the concept of composite supply or mixed supply?
Composite. Becomes a composite supply.
On a composite supply, because now it's a completely a part of the process. Although the contract defines it in two parts, but it's part of the complete process. You identify the market, to identify the customers, and then select the best customer out of the. We can say that this is a market research activity, or then the selection of the customer takes place. But now this is a complete process, because if the customer has to be selected, this process is anyway has to be followed.
Okay, fine. So, RPG, or this one is that it could be a composite supply, and therefore, based on that concept, the predominant supply now becomes the intermediary part of it.
Yes, because if the client is asking me to find a vendor, so I would be doing the entire. So this is part of the process, I think.
All right, great, good. I mean, thank you for the answer.
Yeah, sir, just for an argument. Yeah, just for an argument, sir.
Please
Hello.
go ahead, sir. Yeah, please
so
go ahead.
Just for an argument, assuming it to be a mixed supply.
Yeah.
And where both are taxed at 18%.
Exactly.
What
so that's
would be
my
the
question.
impact?
That's exactly my question. So thank you for. I wasn't able to see who answered. Thank you, sir, for pinpointing my exact. So this is what I exactly wanted to discuss in this particular case. So assume for a second that there's no predominant supply, because please, at least in my view, again, I welcome all of your views, but at least in my view, if you see, both these are critical. If you ask me, one cannot be done without the other. So does it mean that we just change the contract a little bit and make it more success based? Does it necessarily change the color of the supply? That's my question. So probably if we still are able to appreciate that both the supplies are equally important, because one can't be done without the other, and just because the contract is changed a little bit doesn't make one predominant. I'm saying if we are able to take this, then they become equally predominant still. Then if it is a mixed supply, as you are rightly pointing out, now that's the question I want to ask. Assume for a second that it is a mixed supply. If it is a mixed supply in this scenario, then both are chargeable at 18%. This is the critical defect or flaw in the law which I wanted to point out. Do you all agree that Section 8, if we can have a look at Section 8, it takes a rate of, it doesn't give a classification answer per se. It is predominantly meant to answer classification, but it does not end up classifying the product. It just merely ends up determining the rate of tax. Do you all agree? It just says it shall be deemed as a supply of that particular product which results in the highest liability. What if both are equal rate is being applicable? Correct. So what I want to point out to you is, probably I can see, if I go on to say a flaw in Section 8, where instead of trying to classify the product, it merely tries to solve the question of what tax rate is applicable. That results in a lot of problem. What problem? If it merely focus on tax rate rather than what classification to be done, so many problems will come. One, what if both are liable to same rate as we are seeing here? Both are 18% means, then what is the classification? You immediately say, sir, both are 18% means, then the government again is getting 18%. So the other questions are irrelevant, but not so in this case. Please have a look at it. both are 18% okay, but without classification, one, how will we determine whether the place of supply is? Should it be determined under 13, the general clause 13(2), subsection 2, or should it be determined under 13 subsection 8, intermediary? So therefore, if we don't have the answer to that classification point and we merely focus on the rate of tax, then probably these issues will arise. So this is what I exactly wanted to point out. So assuming for a second that there is a mixed supply, section 8 fails to answer the classification here. That's my opinion probably. Therefore, once it fails to answer the classification, whether it is a market research service or whether it is an intermediary service, then how will we determine the place of supply and consequently zero rating or not under section 13 read with section 16 of IGST Act? Now, therefore, three possible scenarios can emerge. One, we can say that since, again, please intercede wherever you feel you have some other view, counter view, but three scenarios can emerge. One, section 8 does not give the answer at all. Section 8 of CGST does not give the answer at all in this case. Therefore, can we say under section 13 subsection 2, I'll determine, because there's no answer, it falls under general category. Therefore, the entire thing falls under general category, means it will be zero rated, the entire contract. Second answer could be, as you are rightly pointing out, that if I treat for a second, that is a mixed supply, and probably, as Arpitji was saying, I treat it as an intermediary service itself. Then in that case, the entire contract now becomes non-zero rated. So first case is the entire thing becomes zero rated. Second situation where the entire thing becomes taxable. And third scenario, and please note in second scenario, why probably there is more credence to it. I also want to point out one more thing to you. If you have the act, please have a look at it. Intermediary service is not defined. Do you all agree with me? What you look at 13 subsection 8, it says intermediary service. Whereas if you go to section 2 subsection 13, it does not define intermediary service. It just defines what an intermediary is. Therefore, if you can think over it, when 13 subsection 8 says intermediary service, does it mean all service of an intermediary? Or does it mean only the facilitation service of the intermediary? So what does section 13 subsection 8 refer to? A basic English reading. Intermediary service means what? It's not defined. So does it mean all the service of an intermediary? Or does it only mean the intermediary service of an intermediary? What does it really refer to? So if you take for a second that 13 subsection 8 would mean all the service of an intermediary, then this probably entire contract would, again, as Arpitji was saying, would be treated as a normal taxable supply and not a zero rated at all. Therefore, the second option could be the entire contract could be non-zero rated normal taxable supply. Whereas the third option would be, now just because I change the contract a little bit, I structure the contract a little differently, doesn't mean that now it gets bundled completely. I can still vivisect the contract. Now comes the vivisection, what we see from Bayana builders, right from service tax era. Now can we vivisect the contract and say still there are two independent distinct supplies are there. One part of it is market research, other part of it is sourcing. Therefore, I'll have to probably, you can say, artificially impute a value to either of these two contracts. And one will still be zero rated, the market research part of it. And the second one, intermediary, will be a taxable supply. So three options could probably emerge out of this. So this is the real facts of the case. I just wanted to take you through the basics and then probably come to the facts which I was fortunate or unfortunate to be part of. So anyway, these three options are there. Anyway, for want of time, I think we have lots to discuss. So I will just conclude by saying in this case, because we have another interesting cases coming up. So I'll just quickly move on. So any other views possible? Any one of you? So can I quickly move on? So if these three options are there,
can we take members' views also, given that there are three options? Where does members tend to put their views?
Absolutely. So yes, so can I move on a little bit? Now comes the next question. Fine. Yeah. In this case, I'll just conclude by saying, now just a variation of this. I'm trying to give the entire. I'm taking you through the entire intermediary sector. So various ways in which the contract is being structured. I'm trying, because I've had a little bit of this one exposure here. So probably I thought I could do this. Third case where let's assume there's a pure intermediary service. There's no study being given, nothing like that. So pure intermediary servicing given, then again comes the question, I don't think I need to discuss in this August forum. If it is a pure intermediary service, there's no study, anything involved, then should it be a CGST, SGST or an IGST? First of all, it will not be zero rated. That's, I think, a given. But whether it will be a CGST, SGST or IGST, so I don't think I need to take that discussion up here. But I probably would want all of your suggestions on this, considering Dharmendra Jani 1, Dharmendra Jani 2 and Material Recycling Association. So what do you all think? Assuming it's a pure intermediary service, leave aside the market research component, will it be a CGST, SGST or an IGST supply? Interstate or an intrastate? Section 7 or Section 8?
Intrastate.
It would be C plus S. Even after Dharmendra Jani 2.
Yeah, intrastate.
Interstate.
Intrastate. CGST.
Intrastate. So I think even after what is that, Material Recycling Association, and even after Dharmendra Jani 1 and Dharmendra Jani 2 of the Mumbai High Court, it's not a Supreme Court decision like Safari. But still the matter is open, I guess. But anyway, my personal view is, considering, if you can just come to the crux of what the decision was. So I think Ganesh is also pointing out IGST. I think I agree with him. So again, it's my personal opinion that if you look at the entire Dharmendra Jani 1 and 2 episode of the Mumbai High Court, if you see the very basic distinction that they have laid out is whether in Section 8, subsection 2, if I am right, it says subject to Section 13, correct? So therefore, subject to Section 13, only we'll have to read Section 8, subsection 2. Therefore, what does Section 8, subsection 2 say? When the LOS and POS are in the same state or the same unitary for that matter, then it becomes an intrastate supply. Therefore, but it starts with saying subject to Section 13, right? So therefore, when the place of supply itself, it starts with saying subject to Section 12, if I'm right, correct? 1 second. So I'll just read it out. Yeah, subject to Section 12. So it starts out with saying subject to Section 12. Whereas in this scenario of an intermediary, we are determining the place of supply based on Section 13, not subsection 12. Therefore, when we are invoking Section 13 to determine the place of supply, will Section 8, subsection 2 really apply? That was the real question. So that is point number 1. The second thing that we'll have to really consider also is, that is what Dharmendra Jani also pointed out, that we'll have to see the entire framing of the GST law with respect to the Constitution. The object of the Constitution again seems to be that all cross-border transactions, just like what it was in the earlier, before GST era also, all cross-border transactions necessarily come under the purview of the center. Therefore, even assuming that the POS is still in the same state, but this transaction would entirely go out of the window of Section 8, subsection 2. Therefore, once Section 13 is invoked and not Section 12, probably will not have to come to Section 8, rather we'll have to go to 7.5c, and therefore still it may be IGST, considering the overall object of the act, to put it very mildly, and how the entire constitution is being framed. Therefore, once the transaction becomes cross-border, I think it comes under the purview of the center. That is what Section 8, subsection 2 also tries to point out. That is what Section 7, subsection 5 also tries to address. So anyway, so considering it's a pure intermediary, whether it is C plus S or I, Dharmendra Jani 2, I think, has a lot to say on this, and I personally believe that it could be IGST, even though CGST, SGST could be a possible practical answer to this scenario. Considering
Sir,
how the states will look at it.
hello, sir.
Yes, sir.
Yeah, sir, you just pointed about 7.5c, sir. For a
Correct.
transaction to come under 7.5c, the supply should be made in the taxable territory.
Yeah.
And it should not be an intrastate supply, and it should not be covered elsewhere.
Perfect.
Now, how do we determine that the supply is made in the taxable territory?
That is exactly the question. So without place of supply, how do you do that? That's exactly the question. So these are a few flaws that are remaining unanswered. And if you look at, when I say 8 subsection 2 also does not apply, I am also adding a few words to 8 subsection 2. where I'm reading the word subject to section 12 as I'm adding the word only there, subject only to section 12. So we are adding a few words when we interpret that 8.2 is also not applicable. Therefore, these are a few things that probably we'll have to keep in mind, questions which are unanswered. But considering Dharmendra Janittu and the overall framing of the, we can say, the division of powers between center and state and how the entire constitution is being framed. So look at the logic of the entire framing. That is what they are trying to point out. But as you rightly said, sir, absolutely, I take that view completely. Anyway, I think we have had a very long discussion. Probably I want to just at least take up, we had 3 cases discussed in the single scenario, but at least I want to take up one more bigger, I think a very interesting case, which I think I'll spend the rest of the session discussing. Again, it's going to be a very deep discussion like this, and it's going to be a multifaceted discussion. So I had one more case study on intermediary, which I want to discuss, but I think since we have discussed so much on intermediary, I think we'll go to another sector. We'll discuss a case regarding corporate guarantee. So I think
just a time check. We are at 9:52.
I know. It was too slow a discussion, but I hope it's all right. I wanted to make it qualitative. I'll just take a quick case with respect to corporate guarantee. I'll put forward the facts. Probably if you don't get all the views right now today itself, it's okay. But I'll put forward the facts to you, and probably we'll have a quick trashing it out. Now let's take a situation where I'll just tell the actual facts of the case, which I was in fact very fortunate to be part of. I thank my colleagues for again trusting me with this particular case. So therefore, I'll put forward the actual facts. This was an actual, this one which happened very recently, just fortunate to be part of. There was this company, let's say H Limited, and who's a typical guarantor for a certain loan of S Limited, a holding and subsidiary company. The loan was sourced from a country X, let's say US or UK. As you can imagine, it's an ECB, external commercial borrowing. Let's say, imagine $10 million loan was being sourced. The guarantee was also for the same amount. And it was given in the year 2016. I wanted to observe the facts of the case really carefully. 2016 it was given. Now it so happened it was a 10-year loan. Therefore, a 10-year guarantee also. Therefore, the contract was there. It was drawn up. One important thing to note in the contract is that the contract in tune with the RBI guidelines also say for this particular guarantee that is being given, there is no consideration at all. There is no commission at all. Clearly spelled out in the contract. Now, it so happened that this guarantor, Holding Limited, I think all of us, understood the facts of the case. So let me quickly move on. Holding Limited, what it did was, in tune with standard Ind AS 109, I think all of us know, it requires us or the guarantor to provide for the probable outflow because it has guaranteed some amount. There could be a possibility where it may be ending up shelling some amount. So considering the present value of the future outflow, a particular provision had to be made, and this provision was, opening provision was made in the year 2016. Let's assume the present value of that provision which was made was, just to put it very mildly, was, let's say, somewhere around $1 million was the provision that was made. Provision was made in 2016, and provision was kept on written off in 2017 onwards till 2025. The provision was kept on written off. Right back, we used to say. Why should it be written back? Because standard 109 also requires that once you recognize a provision, you'll have to reevaluate it every year because risk may increase, risk may decrease. Typically, with the effects of time, the risk decreases. Therefore, just to put it very simply, out of $1 million, let's assume for every year, some $1 lakh, which is like 10% of it is written off every year. Right, so out of $10 lakh, $1 lakh written off every year. Just to put it very mildly, it won't be like this, but for want of time, I'm just rushing forward a little quickly. So every year, out of the first year, 2016, expense was being recognized. And liability was being recognized, year 2016. 2017 onwards, the expense is being written back. And the liability is also being written back, double entry. Double liability and expense are being written back. Therefore, now expense written back means shown as income. Second year onwards, till the whatever, 2025 was the subject matter of the audit also. It was done for 5 years till 2022, the audit was done. So let's keep it till 2022. There were a lot of write-backs or income being recognized. So these are the facts of the case. The audit picked up the income, whatever $1 lakh for each of the years you are recognizing as guarantee income. The standard also specifies that you should disclose it in the face of your P&L. So the holding company had only 2 or 3 streams of income, as all of us know. Holding companies, they don't have a lot of streams of income. Probably some investment income will be there, rental income will be there. And this sort of a holding guarantee income is one of the typical things that is being recognized. So it was picked up, 5 years audit. Show cause notice was issued. Please note under 7(1)(c). Show cause notice was issued under 7(1)(c). Right? Read with Schedule 1. Saying it's a transaction between related parties and without consideration. Therefore, tantamount to a supply. And therefore, you'll have to pay GST on this 18%. On what value? On this 1 lakh for each of the years. This was deemed as the consideration, and therefore GST was being levied. These are the facts of the case. Now let me quickly take up views because I think we have only 5 or 10 minutes. Quickly, let's. These are the facts. Show cause notice being issued. What will be your defenses in this particular case? I asked the August members of this August gathering. Given the facts of the case, what will be your grounds of reply? Any quick answers, please? Am I audible? Are the facts clear?
The guarantee is
Yes, yes.
one-time supply. It is not an ongoing supply.
All
So
right.
it became taxable only from October 23 when that amendment was introduced, and the amendment is prospective in nature and not
Oh.
retrospective. Therefore, one of the argument could be there shouldn't be any tax prior to October 23 for any guarantees which were given in the past.
Okay.
And secondly, now the recent circulars which have also come
Correct.
that XY Indian entity is able to take full ITC, then nil value is also an open market value, and on that ground also no GST would be payable for the past period.
So you're saying the amendments are prospective, but the circulars are retrospective.
Yeah. No, but it is the underlying principle that valuation proviso to Rule 28 that has been elaborated. So that applies for the past period. So the provisions are that way is clear. The notional consideration is only for purpose of accounting standards and GAAP purposes, and as such there is no consideration. It is no invoices raised, nothing is paid. So the tax should not be leviable for the past period.
Okay. Any other? Great
Yes.
answer. So thank you.
Yeah, the supply was made prior to GST.
Yeah.
Because the guarantee was given prior to GST. So there's no taxable event under GST.
Perfect. So that also goes in tune with what Circular 225, if I'm right, also says. Good argument. Any other basic fundamental argument? So in fact, I was fortunate enough to win the case based on this single point only. That leave all things aside, the time of supply was in service tax. So the time of supply being in service tax era, as I was saying in 2016. So time of supply being in service tax era, earlier we had Edelweiss, and we also had the concept where in service tax it was clear that only transactions for a consideration are liable. There's no concept of deemed supply there, or there was a concept of declared service, even that was for a consideration. Here there's no consideration at all. So assuming it falls under service tax, time of supply falls under service tax era. So in that case, if it is without consideration, service tax is not leviable. So that was the point in which I ultimately won the case. This hearing went on for like one of the biggest hearings in my life. You wouldn't believe it was around 14 hearings. 2 officers had changed also. So because of that, it was 14 hearings. So the officer at the end of the day had patiently heard me out. Fine, all I had given, in fact, so many grounds of reply. Patiently heard me out and said, boss, I can't do anything. It's a all over India matter. So don't expect me to give any relief based on legal grounds. So then I finally said, okay, you need not be in trouble. I also need not be in trouble. You look at the time of supply. Time of supply is in service tax. You just say, if at all any tax is leviable, you go and look at service tax era. And the officer was kind enough to grant me that one, because in that particular case, she was not forced to decide on the question of law. and it was a very this one nuanced point in which he gave the relief. So I should be thankful for department side, they're being open-minded to consider these things also. So thank you for pointing that out. That was the point in which I ultimately got the relief in the case. But I want to take the larger picture here. So can I quickly ask you a few questions so that all the members can probably take home some larger learnings from this. Now, my first question to you is, does it fall under 7(1)(c) in the first place? Please tell me. Does it fall under 7(1)(c)? Transactions between related parties without consideration. Now here, there are a few things probably which I will contribute. For want of time, pardon, I'm not taking your views too much and quickly moving on. So I'll just tell my views. Of course, these are all open to debate and all your views are welcome, but I'll just put forward my views. Anything that you strongly want to object to, please let me know immediately. But the views are that if you look at it, please draw a parallel with 126 of Contract Act. If you look at 126 of Contract Act, if you want me, I'll put that up also. I think I have the slide with me. But anyway, I have to move back and forth. If you look at 126 of the Contract Act, which deals with these guarantee surety sort of a situation, security sort of situation, guarantee contracts, there if you look, it clearly points out to the fact that the contract of guarantee is a contract between the guarantor, and the creditor, not the guaranteed person or the debtor. Here there are three parties, one holding, guarantor, subsidiary, debtor, the external person in US, whoever it is, the bank or whoever it is, who's the creditor. Section 126 of the Contract Act clearly points to the fact that a contract of guarantee is a contract between the guarantor and the creditor, not the debtor. Therefore, if you assume that, and if you also look at how the guarantee contracts, I'm not sure, I think many of you would have had a look at it. If you look at the guarantee contract, it will be principally entered into only between the guarantor and the creditor. The guaranteed person, that is the debtor, is nowhere a signatory to that contract. Please go and look at any of the maximum, he'll be an affirming party. He will not be the executor or the one of the executors. So you can look at the documentation itself to prove this point. But look at the wordings of Section 126 of the Contract Act. It is clearly a contract only between the guarantor and the creditor and not the debtor. Therefore, if you ask me, leave aside all this 28(2), leave aside all these circulars, 210 and 225, 204 and 225, leave aside all these circulars. The entire levy itself is not standing, if you ask my view. So that is one of the points I argued. This doesn't fall under 7(1)(c) at all. It is not a contract between related party. Here, the holding company and the external creditor, they have no relationship whatsoever. Please note, it may be this guarantee may be given at the insistence of the creditor, right? So, and that is also a point to be noted. Otherwise, there is no requirement to give this guarantee also. Ultimately, the beneficiary of this may be the debtor. The beneficiary of this may be the subsidiary company here. But does it make him really the recipient of supply, as is defined in the Act also? Therefore, 7(1)(c), whether it is applicable, is itself a question mark. Leave aside 28(2), leave aside circular 204, 225. In fact, this is what I pointed out. In fact, people were surprised when I pointed this out in many forums. Right? Leave aside the rules, whether the entire levy itself is valid without a consideration. That is something we really need to point out. Point number one. Assuming 7(1)(c) is applicable, assuming for a second, that's a contract between related parties without consideration. Take it for granted. Second question is whether there's an actual supply here at all in the first place. There should be a supply between related parties for a consideration. Assume related party is correct. Assume consideration is correct. I mean, no consideration is correct. So, the next question comes is whether supply is there in the first place in this scenario, yes or no? Right now, if you can have a look at it, there are, why am I saying this? You have to look at the parallel rulings in the case of income tax, in case of transfer pricing. In fact, I was fortunate to discuss this in another very august forum, where a lot of TP persons were also there. There are enough number of ITAT rulings. There's no further ruling. There's in fact a few Madras High Court rulings, if I'm right, Sutherland, so on and so forth. But the predominant ITAT rulings are consistently referred to Micro Inc. You can just Google it and see. And there are certain cases relying on Micro Inc., where it clearly points to the fact that this guarantee is a form of shareholder contribution. It's a promoter contribution. Therefore, between the holding and the subsidiary company, why it is giving guarantee in the first place? It is more of a shareholder function. Therefore, this was not tantamount to a supply in the first place. So this could also be taken as one of the grounds. This is why, in fact, even our own institute, one of the accounting standard, if I'm right, it's called the ITFG, right? So it's a framing, it's a guidance body, apart from the ASB, so on and so forth, which guides on the accounting standards part of it. There's a clear guidance being given, recognizing that this is also a form of a shareholder contribution. So these are all things that we need to really see. This is why the circular 204 and 225 for that matter also points to the RBI guideline. If you look at it very carefully, the RBI guideline says the value should be nil, correct? That is in case of personal guarantee. Whereas in the case of corporate guarantee, there are two types of guarantees, right? But what is the underlying logic for saying that the value should be taken as nil? In fact, if you look at the facts of this case, which I pointed out, the contract clearly says the consideration should be nil. Why is that? What is the underlying logic behind it? One, this guarantee should not be used as an office of profit. Director should not profit from it. That is one logic. But the more underlying logic is that it is more of a shareholder function. So there's no supply at all in the first place. So this could also be taken as another argument. Apart from this, of course, we have the arguments of time of supply. As you are rightly pointing out, even assuming in this case, any supply is there coming under the ambit of tax laws, the time of supply, even going by circular 225 says, you assume 1% per annum, but that 1% per annum for 10 years, 10% is to be reckoned at point number times 0. So therefore, it is not a year-on-year supply or a continuous supply, and therefore it is a supply at the initial stage itself. So this is another argument that we could really think of, unless the contract is structured as though it is a continuous supply. But if you look at it, how does it really come under continuous supply? Because the circular says it could be a continuous supply in certain cases. But without consideration, without any payment obligation, how it could be a continuous supply is really a question mark. If you ask me, it could never be a continuous supply. It is always supply at time 0. So to summarize, whether it is a related party transaction, what are the wires of Rule 28 and the relevant circulars? Point number 1. Second, is there a supply at all or is it a shareholding function? Point number 2. Then point number 3, the valuation which is being pointed out, as you are rightly saying, if the revenue neutral transaction, the value should be taken as 0. That is a valid argument. And the circular is also points to deemed value of 1% per annum should be levied at time 0, also points to the fact that the time of supply is always the initial stage, and probably it could never be a continuous supply also. So these are certain things that we could really think of. So I think I've this one I've taken a lot of time. So the idea was whatever little cases we could discuss in detail. I hope you had some points which you could really take away. So with this, any further things to add, you can add, or I'll close with this. Again, thanks to the entire team for giving me this opportunity and for patiently listening to me. Venuji, I think it's up to you. Roopji, anybody is there? Can we conclude, or any further thing to add?
Yeah, let's conclude. RPG, any final remarks from you before we conclude?
Thank you, Venuji. The session was so exhaustive that there are no more final remarks to be given. Both the case study which were taken were tinged with the practical aspect, because the speaker himself has argued and has been in midst of both the cases. So all the relevant practical aspects were also attached to the case studies. And yes, the initial part when Shravanji said that only Earth was stated to carry over to the next critical issue, the initial case study which was shared by him also took half an hour. The majority of the time was taken by the initial case study, but it set the tone for the next case study. So the members also interacted very well during the course of the session, because all these issues are such issues which we are facing in our day-to-day. How to draft the contract, what are the issues of composite supply, mixed supply, what are the issues of two independent suppliers, and very important point which was highlighted was section 8 mixed supply, that even if the tax rate is same, how to classify between a two, which would be the relevant supply by which the mixed supply would be classified. So all in all, a very interactive and a very thought-provoking session. Thank you to our speaker for bringing out all his experience and sharing all his experience in today's session. And since he was sharing all the practical aspects, so it was pretty obvious that time had to be crossed, and we had crossed by 10 minutes. So nothing of that much sort. And thank you all the participants for joining in and sharing your views. Thank you very much.
Thanks again, Vijay, and thanks everyone for the opportunity. Thank you for patiently listening to the members.
Thank you, Shravana sir. Thank you,
you.
Arpit bhai, and thank you everyone. Happy Vijayadashmi again, and have a nice festive celebration. Thank you all. Bye.